Hey guys, I'm here today with a quick lesson on what bonds are and how to use them properly. A bond is a loan given by a corporation or a central government. And basically, what that loan says is, well, let's use an example. Let's say the United States government gets into a big infrastructure project and they need to raise money. So instead of looking for big banks or for foreign nations to provide the money, they look to their own people. So what they're going to do is they're going to start issuing out bonds. So these are pieces of paper that are promises made by the government that cost $1,000. And what these bonds say is that they will pay you, for an example, a 5% interest over the course of 5 years and then return the initial payment at the end of the bond term. So for $1,000, you're going to get paid $50 every year for the next 5 years, and at the end of the 5th year, you're going to receive your principal back, so the $1,000. In essence, this is a relatively safe investment because the United States has never defaulted on a bond before. Therefore, since the risk is lower, the payout usually isn't 5%. It's much lower than that, usually totaling anywhere from 2.5 to 3% depending on the length of the bond. The longer your money is with the United States government, the more they're supposed to pay you. In normal circumstances, this can change and we might cover that in later videos, but it's a more advanced topic. This does two things. One, it raises the money the government has at a specific moment. After selling out the bonds they have, the government has now successfully raised and earned the money they needed to complete the project. The second effect of this is that now they're adding money to the monetary system. By making these regular payments to all the people that bought their bonds, they are injecting cash into the hands of the people of America. This allows the system to remain liquid and also allows the government to raise money in order to complete public works. The problem comes when you look at where that money usually comes from. It usually comes straight from the mints. They just print out this money and they give it out to their people. There are other ways to raise it, say taxes or other things of that nature, but usually the Fed likes to keep a steady rate of inflation, which is what happens when you inject money into the money supply. Because of this, the rate of inflation has been increasing steadily over the past 50 years ever since America got off the gold standard, and therefore the rest of the world got off the gold standard. So that's a basic overview of bonds, and now we're going to get into some finer details. Usually, bonds are used in a portfolio to mitigate risk. They're usually lower return than stocks over the long run, but they have a much more consistent yield. So if you're trying to build a risk-free portfolio, well, not risk-free, but if you're trying to build a minimized risk portfolio, bonds are usually a great add, especially government bonds. But there's one risk that always comes with buying bonds. If for some reason, either due to war or economic turmoil, the inflation rate of money grows past your bond rate, you actually start losing potential money on the bond. Basically what happens is that, let's say you have a bond that returns 2% a year. But money is inflating at 3% a year. Your net return is negative 1% because their money they're paying you does not cover the amount of buying power you're losing every year just by holding onto that money yourself. So the only way to counteract this is to invest in equities, which usually tend to increase in price along with inflation. Another risk for non-government bonds is default. If the company issuing the bond goes bankrupt, they could stop paying you the money, because the corporation is no longer there to make payments. Usually, bonds that have a higher risk of default rate, usually these bonds have a higher interest rate. These are usually called high-yield corporate bonds. If you ever see that in one of your portfolios or 401ks, now you know what it means. They're just companies that have a higher risk of defaulting, so they have to pay you more money to cover that risk. Now, the last and final thing I want to talk about with bonds is a little bit more of a complex or abstracted topic. And these are ETF bonds. So these are exchange-traded funds that go around bonds. Basically what happens is a large company or investment bank buys up a whole bunch of bonds that cover either a large range or a specific niche depending on what fund you're buying. What this allows you to do is give money to that bank or that fund manager, and he takes it and buys shares of the fund. And then this fund returns an average of all those bonds they bought. Usually, you'll pay a fee to the person managing the fund. That's how they make their money. But for this fee, you'll have the added benefit of having liquidity in your bonds. At any point you want, you can go to the fund or the market where the fund is traded and sell that share of the fund to someone else. Usually with bonds, you cannot do this because it is a contract between a person and a corporation or a government. And in order to find a way to get rid of it or make that money that you gave to that corporation or government liquid, you would have to find someone who is willing to buy that bond from you, usually at a lesser price. And that's very difficult to do if you don't have connections, and especially if your bond is something that's high risk. But buying into a fund, all of that is taken care of you. The fund manager or bank will put it on a market and will try to find someone who is willing to buy it for the price you're willing to sell. This is kind of how stocks work, but just with bonds. So for a little bit less return on investment in the form of paying fees, you get a higher liquidity of your money, making bond ETFs one of the safer ways to invest your money in the short term. Because not only is it highly liquid, but it's usually very stable, and if you invest in companies or in governments that have not defaulted on their debts, then you have a very high chance of receiving your money in a timely manner. I hope this has taught you guys a lot about bonds, and if you have any questions, put them down in the comments, and I'll try to answer them as quickly as I can. Remember to like and subscribe if you want to learn more about financial stuff, not only from me, but from other people on YouTube. And as always, have a great day.